Hey everyone, welcome to this explainer. I am so thrilled you're here today because we are going to unpack something incredibly powerful. We're setting the stage for a strategic guide on optimizing your retirement savings and navigating the really complex new tax codes rolling out in 2026. This isn't just about putting pennies in a piggy bank, it's about making smart, strategic moves to keep way more of your hard-earned money. Okay, let's dive right in.
So, what if you could literally turbocharge your savings right at the buzzer, exactly when it matters most? If you're a late career high earner or a small business owner, the fourth quarter of your career is prime time. Your earning power is likely at its peak, and the IRS actually gives you special tools to accelerate your savings. But here's the catch. With the new Secure 2.0 rules, the playbook is changing drastically. If you aren't paying attention, you could be leaving a massive amount of tax-free growth on the table.
Here's our game plan for today. We're going to cover the catch-up basics, the new SECURE 2.0 rules, stacking tax advantages, avoiding the pro-rata trap, and finally, what employers must do.
All right, kicking things off with Section 1, the catch-up basics, and looking at those 2026 limits for late career savers.
Okay, before we get fancy, let's talk base numbers. We need to know exactly how much the IRS allows us to shelter. Secure 2.0 brought us this brand new concept called the super catch-up. Basically, the IRS knows ages 60 to 63 are the ultimate crunch time before retirement, so they created a supercharged limit to help you sprint to the finish line.
Let's look at the actual numbers for a 401k or 403b in 2026. If you're under 50, your standard limit is $24,500. Turn 50 and you get an $8,000 bump, bringing you to $32,500. But the real star of the show is that 60 to 63 bracket. Thanks to the super catch-up, your total limit shoots all the way up to $35,750. That is a huge opportunity to shelter income.
And hey, it's not just 401ks getting a bump in 2026. Standard IRAs sit at a $7,500 limit with $1,100 catch-up if you're 50 or over. Simple IRAs bump up to a $17,000 standard plus a $4,000 catch-up. But listen, do not sleep on the Health Savings Account, or HSA. You can stash away $4,400, and if you're 55 or older, you get an extra $1,000. Put a pin in that HSA, because it's going to be a total secret weapon later on.
Moving right along to Section 2, Secure 2.0 New Rules, focusing on the high earner mandates for 2026.
All right, here's where the plot thickens. The IRS isn't just giving out higher limits, they're fundamentally changing how you can contribute. The magic number to remember here is $150,000. If your prior year FICA wages from your employer cross that $150K mark, your entire playbook flips starting January 1st, 2026.
Let's break this down really simply. If you earn under $150K, business as usual. You can choose whether your catch-ups are pre-tax or after-tax Roth. But if you earn over $150K, the IRS mandates that absolutely all of your employer-sponsored catch-up contributions must strictly be made on an after-tax Roth basis. You don't get that upfront tax deduction anymore. Yes, your net paycheck takes a little hit now, but the massive upside is that all that money grows and comes out completely tax-free in retirement.
Now, you might be thinking, wait, my company's 401k doesn't even have a Roth option. Well, under these new rules, if there's no Roth option, high earners literally won't be allowed to make catch-up contributions to the 401k at all. Crazy, right? But don't panic if you're in that boat. You've got fallbacks. You could funnel those catch-up dollars into a Roth IRA directly, assuming you meet the income limits, or utilize a backdoor Roth conversion strategy to get that money into a tax-advantaged wrapper.
Next up, Section 3, stacking tax advantages, or what we like to call the teammate strategy.
Okay, let's level up. Too often, people treat their accounts like they're in silos, but they're not. They're actually teammates. Here is your optimal order of operations. Step 1, fund that HSA for current medical expenses. Step 2, pivot to your 401k, just enough to grab your full employer match. Never, ever walk away from free money. Step 3, circle back and max out the HSA for long-term growth. And finally, Step 4, max out whatever is left in your retirement accounts. Why do we prioritize the HSA? Because it's literally the only account out there that is triple tax advantaged.
If you're wondering why I'm hyping up the HSA so much in this explainer, check out this staggering stat. Fidelity estimates that a single 65-year-old retiring in 2025 is going to need about $172,500 in after-tax savings just for medical expenses. Just medical. That doesn't even touch long-term care. If you have to pull that $172K from a regular taxable 401k, you actually have to withdraw way more just to cover the taxes on the withdrawal. But if that money comes from an HSA, 100% tax-free.
All right, diving into Section 4, avoiding the pro-rata trap and dealing with the math pitfalls and backdoor Roths.
Welcome to the boss fight of our strategy guide. When high earners try backdoor Roth conversions, the IRS has this nasty little trap waiting called the pro-rata rule. Basically, it forces your Roth conversions to be taxed proportionally based on your total mix of pre-tax and after-tax money across all of your IRAs. You can't just cherry-pick your after-tax dollars and say, I'm only converting these to avoid the tax bill.
Let's put some real numbers to this so you see how it bites you. Say you've got a $200,000 IRA portfolio. 150K is pre-tax, and you just dropped in 50K of after-tax money. You're probably thinking, awesome, I paid taxes on that 50K already, I'll just convert it to Roth and pay zero tax. Yeah, no. The IRS looks at the whole pie. Since your account is 75% pre-tax, the IRS says 75% of your $50,000 conversion is taxable. Boom. You're suddenly paying income tax on $37,500, which completely ruins the efficiency of the backdoor strategy.
So, how do we legally dodge this trap? Well, you've got options. You could stick to just one contribution type to keep the math perfectly clean, or spread your conversions out over multiple years so you don't accidentally bump yourself into a massive tax bracket. But here's a pro tip advisors absolutely love. Roll your pre-tax IRA money into your current employer's 401k. The IRS doesn't count 401ks in the pro-rata math, so it completely isolates your after-tax IRA dollars for a clean conversion. You can also use those pre-tax funds for charitable distributions if that's your thing.
Finally, Section 5, what employers must do to prepare for the 2026 amendments.
All right, business owners, HR pros, and plan sponsors, this part is for you. The rules are shifting, and your plan documents have to keep up. Here's your timeline. Sometime in the first half of 2026, expect an amendment notification from your provider. Second half of the year, the official amendment lands on your desk for a signature. And circle this on your calendar. December 31, 2026 is the absolute hard deadline to adopt these Secure 2.0 changes, no exceptions.
Now, to make things a little easier, your provider is probably going to apply some default compliance-focused provisions automatically, unless you actively opt out. Usually, this means letting employees self-certify their hardship withdrawals, bumping the involuntary force-out threshold for former employees from $5K up to $7,000, and excluding certain employees from top-heavy minimum calculations. Honestly, these defaults are great because they really cut down on your administrative headaches.
But please, don't just blindly sign off on the defaults. You really need to look at discretionary upgrades. The biggest one? Like we talked about earlier, if your plan doesn't currently offer a Roth 401k option, you absolutely must consider adding it. If you don't, anyone making over $150K is going to be legally locked out of catch-up contributions in 2026. While you're at it, maybe look at dropping hours-based eligibility so you aren't constantly tracking part-timers, and get rid of cash-out options for tiny balances so that money actually stays invested.
As we start to wrap this explainer up, I keep coming back to this idea. HSAs, 401ks, and IRAs aren't rivals, they're teammates. That right there perfectly summarizes the core theme of strategic financial planning. It's not just about having the accounts, it's about knowing how the pieces fit together, especially when these new Secure 2.0 rules are forcing us to call new plays. Because at the end of the day, the goal isn't just saving money, it's actually keeping more of what you earn. The tax code is essentially a giant rule book, and right now those rules are being completely rewritten. So do yourself a huge favor, sit down with a financial advisor or a tax pro and get your personalized, tax-efficient playbook locked in way before these 2026 mandates roll around.
So, I'm going to leave you with this final thought to chew on. Take a really hard look at your current setup. Are your retirement accounts actually working together as a cohesive team, or are you accidentally leaving massive amounts of tax-free growth just sitting on the table? Thanks so much for hanging out with me for this explainer. Now get out there and optimize that playbook.